July 1944, Mount Washington Hotel, New Hampshire. 7:30 delegates from 44 nations meet for 3 weeks while the world is still at war. They aren't just designing the peace, they're designing the money system that will anchor it. You weren't invited, neither was anyone you know. But the structure built in that room still shapes what you pay for food, fuel, and rent today. Here's the mechanism. One country issues the world's reserve currency. That gives it a unique privilege, but it also exports side effects. Over decades, those side effects behave like an invisible bill on global purchasing power. In the next 20 minutes, you'll see 3 things. First, what Bretton Woods built and why it looked stable. Second, what broke in 1971 and why the infrastructure survived anyway. Third, the simple chain that connects Federal Reserve policy to prices worldwide. The gold anchor, how Bretton Woods was supposed to work. The men at Bretton Woods faced a problem. The rigid gold standard had collapsed during the Depression. Competitive currency devaluations had worsened the crisis. Pure fiat money terrified economists who remembered the Weimar hyperinflation. They needed a compromise. Something stable enough to prevent chaos, flexible enough to allow growth. The solution, currencies would peg to the dollar would peg to gold at $35 per ounce. Fixed exchange rates would prevent the beggar thy neighbor devaluations of the 1930s. International trade could expand without currency risk. If that sounds like ancient history, here's the point. The world still runs on dollar settlement. That means U.S. monetary decisions still ripple through commodity prices and currency stability, especially outside the U.S. The system required a hegemon. The United States held 2/3 of the world's gold reserves after the war, roughly 22,000 tons. No other nation came close. Britain was bankrupt. Europe was rubble. The Soviet Union didn't participate, so the dollar became the anchor. Other central banks could exchange dollars for gold at the fixed rate. This convertibility was supposed to discipline U.S. monetary policy. Print too many dollars, lose your gold. Simple. 2 institutions emerged as safety valves. The International Monetary Fund would provide short-term liquidity to countries facing temporary balance of payments crises. The World Bank would fund reconstruction and development. Both were designed to keep countries from abandoning the fixed exchange rate system during economic stress. The promise was stability. Predictable exchange rates would facilitate trade. Gold backing would prevent inflation. The system would self-correct through gold flows. Countries running deficits would lose gold and tighten policy. Countries running surpluses would gain gold and expand. But the system contained a hidden assumption. It required the United States to remain disciplined, to resist the temptation to print dollars beyond its gold reserves, to prioritize global monetary stability over domestic political pressures. French economist Jacques Rueff spotted the flaw in 1961. He called it a house of cards. The system actually incentivized U.S. deficits. Foreign central banks needed dollars for reserves and trade. They accumulated dollars instead of demanding gold. This let the U.S. run deficits without immediate consequence. The more the world economy grew, the more dollars it needed. The more dollars the U.S. created, the less gold backed each one. The math was straightforward. The political will to address it was not. For 27 years, the system functioned as designed. International trade expanded. Currencies remained stable. The post-war economic booms seemed to validate the Bretton Woods framework. Then the math caught up. The 1971 pivot, when the anchor was cut but the chain remained. The Vietnam War cost money. The Great Society programs cost money. The United States was fighting a war abroad and funding social transformation at home. Both required dollars the Treasury didn't have, so policy turned to monetary expansion. Between 1965 and 1971, U.S. gold reserves fell from 15,000 tons to 9,800 tons. Foreign central banks were converting dollars to gold at the fixed rate. The drain accelerated. Charles de Gaulle understood what was happening. In 1965, France demanded $1.5 billion be converted to gold. The US shipped 3,000 tons across the Atlantic. Germany made similar demands. Japan followed. The math became impossible. By 1971, foreign central banks held more dollars than the US had gold to cover. At $35 per ounce, US reserves couldn't back even a fraction of outstanding dollar claims. August 15, 1971, President Nixon appeared on television. He announced the suspension of dollar-gold convertibility. Temporary, he said, a brief measure to defend against speculators. It was never reinstated. Nixon also imposed a 10% surcharge on all imports. The message was clear: revalue your currencies upward, or your exports become uncompetitive. The surcharge was economic pressure dressed as temporary policy. Within months, the Smithsonian Agreement was negotiated. Major currencies were revalued against the dollar. The import surcharge was lifted. The dollar was officially devalued to $38 per ounce of gold, though the convertibility itself remained suspended. The system limped forward for 2 more years. By 1973, fixed exchange rates collapsed entirely. Currencies floated. The Bretton Woods exchange rate mechanism was dead. But here's what didn't change. The dollar remained the world's reserve currency. The infrastructure built in 1944 stayed intact. Oil was still priced in dollars. International trade still required dollar reserves. Central banks still held U.S. treasuries. The anchor was gone. The chain remained. This created something new, a pure fiat dollar backed by nothing except the institutional inertia of the global financial system. No gold discipline, no automatic correction mechanism, just the network effects of 27 years of dollar-denominated trade. The system now required what had previously undermined it. To supply global liquidity, the U.S. had to run perpetual deficits. The world needed more dollars than the U.S. economy naturally produced through trade. This was Triffin's dilemma, realized. Yale economist Robert Triffin had warned in 1960 that the Bretton Woods system contained a fatal contradiction. To provide the world with enough dollars for growing trade, the U.S. must run deficits. But running deficits would eventually undermine confidence in the dollar's gold backing. He was right about the contradiction. He didn't predict what would happen after the gold backing disappeared. The system didn't collapse. It mutated. The dollar's reserve status now rested entirely on momentum. Every country held dollars because every other country held dollars. Every commodity was priced in dollars because it had always been priced in dollars. Switching costs were enormous. The alternatives were fragmented. So the temporary suspension became permanent. The dollar floated free of gold, but remained anchored to global trade. The U.S. could now expand its money supply without losing reserves. Foreign central banks had no recourse except to hold the depreciating assets. This is where the invisible bill became a permanent feature of the global system. The mechanism that taxes your purchasing power was locked in, not through gold, through institutional dependence that no single nation could afford to break. Exporting inflation. The mechanics of the systemic tax Valéry Giscard d'Estaing had a term for what happened after 1971. He called it the exorbitant privilege. France's finance minister understood the mechanism better than most. Here's how the tax works. When the world needs dollars to trade, U.S. policy becomes a global input, especially for commodities and emerging market currencies. Other nations produce real goods, cars, electronics, agricultural products to acquire dollars. They need dollars to buy oil, to settle international debts, to hold as reserves against currency crises. The demand is structural, not optional. The United States creates those dollars at near zero cost. A few keystrokes at the Federal Reserve. No factories required, no exports necessary, just monetary expansion backed by the institutional inertia of the global system. This creates an asymmetry. When the Fed expands the money supply, those new dollars flow into global markets seeking yield. They don't stay in the United States. They flood into emerging market bonds, commodity futures, foreign real estate. Foreign central banks and businesses absorb these dollars. They hold them to facilitate trade, to maintain currency pegs, to service dollar-denominated debts. The global economy effectively functions as a sponge for U.S. monetary expansion. Now, watch what happens to prices. As dollar supply increases, the dollar weakens against other currencies, but not uniformly. Emerging market currencies weaken more. Their central banks face a choice: let their currency collapse or raise interest rates to defend it. Either way, their economies slow. Meanwhile, commodities are priced in dollars. Oil, wheat, copper, all traded in dollars regardless of where they're produced or consumed. When the dollar weakens against producer currencies, producers demand higher dollar prices to maintain their real income. A Brazilian farmer sells soybeans for dollars. The real weakens 20% against the dollar. The farmer's dollar revenue buys 20% less in local currency, so the farmer raises prices. Brazilian consumers pay more for food despite Brazil being a food exporter. This is the grocery store connection, the mechanism that links Federal Reserve policy decisions to what you pay for eggs in São Paulo or Mumbai or Cairo. Countries that dollarized completely, Ecuador, El Salvador, Zimbabwe, surrendered even the pretense of monetary sovereignty. They import U.S. monetary policy directly. When the Fed expands, they experience inflation. When the Fed tightens, they experience deflation. They have no control over their own price levels. The feedback loop is self-reinforcing. Emerging markets raise interest rates to defend their currencies. Higher rates slow growth. Slower growth reduces demand for commodities. Commodity producers earn less. They have less money to buy imports. Global trade contracts, the U.S. benefits from cheaper imports while exporting its inflation. Foreign central banks hold roughly $12 trillion in U.S. treasuries. They're trapped. Selling would crash the value of their remaining holdings. It would strengthen their currencies, making their exports uncompetitive. So they keep buying, even as the real value erodes. When Treasury yields rise, foreign holders face losses. A 1% increase in yields on a 10-year bond means roughly 9% capital loss. Multiply that across trillions in holdings. The losses are enormous, but selling accelerates the losses. They're locked in. This is why the system persists. No single nation can exit without catastrophic cost. The switching costs are too high. The alternatives are too fragmented. The network effects too powerful. The exorbitant privilege isn't a conspiracy. It's not a secret plan. It's an emergent property of the institutional framework built in 1944 and modified in 1971, a structural incentive problem that compounds over decades. The structure creates the incentives create the outcomes compound over time. Every monetary expansion, every deficit, every treasury auction, they all function as a tax on global purchasing power. The tax is invisible because it's distributed across billions of transactions in hundreds of currencies, but it's real and it's measurable in the price of food, fuel, and imported goods worldwide. The grocery price link, real-world examples of the invisible bill. This isn't theoretical. We can trace specific policy decisions to specific price increases in specific countries. When the world needs dollars to trade, U.S. policy becomes a global input, especially for commodities and emerging market currencies. 2020 to 2022, the Federal Reserve expanded its balance sheet by $4.8 trillion in response to the pandemic. Quantitative easing on a scale never before attempted. The stated goal was domestic economic support. The global effect was immediate. The dollar index weakened initially, but emerging market currencies weakened more. Turkey's lira lost 44% against the dollar in 2021. Food inflation in Turkey hit 89%. Not because Turkey stopped producing food, because the lira collapsed, making imports expensive and giving Turkish producers an incentive to sell abroad for harder currency. Oil demonstrates the mechanism clearly. Crude is priced in dollars globally. When the dollar weakens against producer currencies, the Russian ruble, the Saudi rial, the Norwegian krone, OPEC faces a problem. Their dollar revenue buys less in local currency, so they raise prices. The entire world pays more, regardless of whether their currency weakened or strengthened against the dollar. Brazil exports soybeans, coffee, sugar. In 2021, the real devalued 7% against the dollar despite strong commodity demand. Brazilian food prices rose anyway. Producers could sell for dollars abroad or reais domestically. The dollar option became more attractive. Domestic supply tightened. Prices rose. This is the paradox of being a food exporter in a dollar-dominated system. Your currency weakens, your farmers get richer, selling abroad, your population pays more for domestically produced food. Central banks try to manage this through reserve accumulation. They hold $12 trillion in U.S. treasuries as a buffer, but this creates its own trap. When Treasury yields rise, foreign holders face a choice: hold and accept capital losses or sell and crash their own currency. In 2022, Japan spent $42.8 billion in October alone intervening to slow the yen's fall. The point isn't the exact number, it's the structural pressure created when the global system tightens around the dollar. Foreign ownership of U.S. Treasuries has declined from over 50% during the 2008 crisis to roughly 30% in early 2025. Not because foreign central banks want to reduce exposure, because they're being forced out by the mathematics of maintaining currency stability while the Fed runs unprecedented deficits. Argentina demonstrates the extreme case. Every time Argentina pegs to the dollar or dollarizes, it imports U.S. monetary policy wholesale. When the Fed tightened in 2022, Argentina experienced deflation despite domestic political chaos. When the Fed expanded in 2020, Argentina experienced inflation despite lockdowns reducing demand. They have no control over their own price level. Lebanon dollarized informally after its currency collapsed. Now, Lebanese pay for groceries in dollars they don't print, based on prices they don't control, with an exchange rate determined by a central bank in Washington that doesn't consider Lebanese purchasing power. The system is showing cracks. The question isn't whether these examples prove the mechanism exists. The data is clear. The question is whether the cracks lead to reform or fragmentation. The end of the epoch? Emerging challenges to the 80-year system. The system is fracturing, not collapsing, fracturing. The difference matters. When the world needs dollars to trade, U.S. policy becomes a global input, especially for commodities and emerging market currencies. That structural dependence is what's beginning to fragment. Russia and China are building alternative payment rails. After Western sanctions excluded Russia from SWIFT in 2022, the incentive became existential. Russia's SPFS system now handles a significant portion of its intra-BRICS trade in local currencies. China's CIPS processes yuan transactions without touching dollar infrastructure. The bigger measurable trend is in central bank behavior. According to the World Gold Council, central banks purchased over 1,000 tons of gold for 3 consecutive years, 2022, 2023, and 2024. This represents the highest sustained buying since Bretton Woods collapsed. They're not doing this for yield. Gold pays no interest. They're doing it for optionality. For a reserve asset, no central bank can debase through monetary policy. Experiments with alternative settlement mechanisms are emerging across BRICS plus nations: Brazil, Russia, India, China, South Africa, plus Egypt, Ethiopia, Iran, and the UAE. These include bilateral currency swaps and commodity-backed trade arrangements. The systems are incomplete and fragmented, but the direction is clear. The dollar's share of global reserves has declined to the mid to high 50s, according to IMF COFRA data, the lowest level in 2 decades. Still dominant, still irreplaceable in the short term, but the trend is measurable. The network effects that sustain dollar hegemony are weakening. The structural problem is Triffin's dilemma reaching its mathematical limit. U.S. debt to GDP stands at 130%. The system requires the U.S. to run deficits to supply global liquidity. But those deficits are now large enough to undermine confidence in the currency itself. Europe can't replace the dollar. The euro lacks fiscal union. Without a unified bond market and a single fiscal authority, the euro remains a regional currency. Germany won't underwrite Italian debt. France won't accept German fiscal rules. The political compromises required for reserve currency status don't exist. China's yuan is growing but constrained. Capital controls limit convertibility. The bond market isn't deep enough. Foreign holders can't easily exit yuan positions at scale. Until China opens its capital account, which would require surrendering control over domestic credit, the yuan remains a bilateral trade currency, not a global reserve. What's emerging isn't a replacement, it's fragmentation, bilateral currency swaps, regional settlement systems, commodity-backed units for specific trade corridors. A multipolar drift where no single currency dominates, but the dollar's monopoly erodes. To be fair, the dollar system also reduced transaction friction and supported post-war trade growth. The debate isn't whether the system provided benefits. It did. The question is about costs and distribution. Who benefits from the arrangement and who pays the invisible bill? Historical precedent suggests this process takes decades. The pound sterling's decline from reserve dominance took 50 years. It didn't happen through a crisis. It happened through gradual erosion as the British economy weakened and alternatives emerged. The dollar may follow a similar path. Not a sudden collapse, a slow fade as countries build alternatives, reduce exposure, and diversify reserves. The grocery price link weakens not because the system reforms, but because global trade fragments into regional blocks with separate settlement mechanisms. For now, the 1944 framework persists. The dollar remains the default, the alternatives are incomplete, the switching costs are enormous, but the cracks are visible. The mathematical contradictions are compounding. The political will to maintain the system is eroding. Understanding this doesn't require predicting the endpoint. It requires recognizing the trajectory. Conclusion: the first step toward financial clarity. The Bretton Woods framework didn't create a conspiracy. It created a structure with predictable outcomes, a system of institutional incentives that compound over time. That structure effectively functions as a tax on global purchasing power. Your grocery prices reflect decisions made in 1944 and 1971, compounded by every monetary expansion since. The system persists because alternatives require coordination costs no one wants to pay. The mechanism is visible once you know where to look. Understanding it is the foundation for navigating what comes next. If this analysis added value, subscribe for more deep dives into the systems that shape your financial reality.